Well, good morning, everybody. Hope you're doing well today. I don't know if you can see it outside my office windows or not, but it's actually snowing here in western Kentucky. A little bit cold out there, so it's not a bad day to be inside, catching up on some projects, and thought I'd make a video in the midst of all that too. So, in case you don't know me personally, if an internet search brought you here, if somebody shared this video and that's how you found me, welcome. I'm glad you're here. But just to introduce myself, my name is Jason Potts. I'm a CPA. I operate out of my office in Maceo, Kentucky. You see my contact information here on the screen. Maceo is outside Owensboro, Kentucky, about 2 hours west of Louisville, Kentucky. So if you're familiar with where that is, you got an idea where I'm at. I've made a series of these videos, and as I've said in introducing some of them, my practice, my CPA practice, a big part of it has turned into helping my clients understand basic financial concepts, to help educate them on basic financial concepts, help them succeed in their financial lives by understanding these concepts better. Today's video is no exception to that. Hopefully by the time you watch it, you'll understand the subject a little bit better. And if you do, I ask that you like this video, comment on it. If you have any feedback on it, of course. If you have suggestions for future videos, and if you'd like to see more of these videos, please subscribe to my channel, and I'll put these out as things come up. So today's topic is something that we've seen in the news. One of my previous videos was a little bit about debt, talked about why you want to avoid debt as much as possible. Why I've seen some of my clients really succeed by avoiding debt. I've seen other clients, really good people, both cases, but I've seen others really struggle in their financial lives by getting overwhelmed with debt, taking on too much debt. And so something we've seen in the news here lately is the concept of a 50-year mortgage. Now those are actually not very common right now. They are out there. You can get a 50-year mortgage. What we're seeing in the news lately is that the government would be backing those 50-year mortgages, and right now they don't back 50-year mortgages, and that's why they're not very common. The political stuff is a little bit out of above my pay grade, out of my wheelhouse. That's my understanding of why it's being discussed. And I won't get too deeply into politics. This is something that President Donald Trump has suggested, started talking about. And anybody who knows me personally, I generally agree with President Trump on most things. But like every politician that's been around in my lifetime and before that, and I'm sure after that too, I don't agree with everything. And this I don't agree with. Again, I don't want to get too political, although that's very easy for me to do. Screwing up is a bipartisan thing. The government screwing up is a bipartisan thing. And what I mean there is that politicians of all parties are pretty good at it. President Trump, again, I generally agree with him, but I don't agree with this. We talked in one of my previous videos about the spiritual, the moral, the mental, and of course some of the financial aspects of debt. And a 50-year mortgage just brings out the worst of all those things. It just makes everything that's bad about debt, and makes it worse. So let me flip over to a spreadsheet, as I often do. As I mentioned in one of those videos, I generally do everything in spreadsheets, so today's discussion is no different. So let me get over here. All right, so we're going to walk through a calculation just to get us on the same page. I've got displayed here two different mortgages, some basic calculations on two different mortgages, a 15-year and a 30-year. Those are the most common terms. You can get shorter than 15, you can get longer than 30, you can get somewhere in between. But these are, generally speaking, what people, when they purchase a house, have, a 15-year mortgage or a 30-year today. And so you start with just to walk through the calculation, you start with the price of the house, the house that you're buying. I just did a quick search. I've got the link down here in case you want to go to it, see for yourself. You can also, you've got Google. You can also search for yourself. But this site and a couple other sites I looked at, the average home price in Kentucky today, 2025, is about $225,000. So we start with that. I assumed that you're doing a good financial practice of having at least a 20% down payment. Your mortgage rate is going to be higher. You see my note down here that the rates assume a 20% down payment and good credit, a good credit score, or otherwise other measure of credit worthiness. So I assume that you're going to have a 20% down payment on a $225,000 house. That's $45,000. So a good down payment, a high down payment, makes your mortgage rate lower, makes your interest paid lower, and it also reduces, or it eliminates, if it's this high, mortgage insurance. So basically, when you have mortgage insurance, you are paying for insurance on behalf of the mortgage company. Mortgage insurance doesn't do anything for you except allow you to get a loan with a lower down payment. But what it does is it protects the mortgage company from, or the bank from, you not paying. And so you're buying insurance for to insure them, not to insure you. But anyway, 20% down payment. So 225 minus 45 equals 180. I looked up these interest rates, and again, it's based on a 20% down payment, based on having relatively good credit. You can get around here at least a 15-year mortgage for interest rate of 5.375%, or a 30-year for 6%. Now, why is it higher, you might ask? And the reason that it's higher is that the longer you are an investment to the lender, on your side it's a loan, on their side it's an investment. The longer you're an investment to them, the riskier you are. There's a risk of you not paying. That's pretty much mitigated by the fact that they can come take your house if you don't pay. But the risk of you not keeping the mortgage. So, how many people do you know that stay in their house for 30 years? If you have a 30-year mortgage, you move out after 20 years, well, you're not going to have this 30-year mortgage. So their assumption that they're going to have a 30-year income stream is out the window if you move and you get rid of your mortgage before the end of the term. And so also they're taking on the risk of the house going down in value. So again, there's a lot of risk that a lender is taking on with a longer mortgage versus a shorter one. And that's why they have a slightly higher rate to again, make you, the borrower, pay for their risk, cover their risk. And so, again, a little bit higher interest rate, of course, 15 years in a 15-year mortgage, 30 years in a 30-year mortgage. In a 15-year mortgage, with all the inputs that we've set up here, your monthly payment will be about $1,460 a month. You'll pay $262,000 to the lender, add in your $45,000 down payment, and you will pay $307,000 roughly total for your $225,000 house. The difference in between that number and $225,000 is about $83,000. That's how much interest you've paid. That's the cost of having this mortgage for 15 years. Now, I look at that number and my skin just crawls. As I said in the previous video, I hate debt. I avoid it. My family avoids it. We generally do fairly well financially because we do that, and I've seen other folks do very well by avoiding debt too. So you've paid $82,000, $83,000 for the privilege of using somebody else's $180,000 for 15 years. That is a layman's terms of explaining why you pay interest over the course of a loan. 30-year mortgage, using the inputs that I outlined a minute ago, your monthly payment is lower simply because there's more of them. Even though your interest rate is higher, you're spreading this out over 30 years, and so your monthly payment is lower, no doubt. It's just math. That's the way the calculation works. However, since you're making that lower monthly payment over a whole lot more months, double the number of months, you're paying quite a bit more to the lender. You're paying $388,000 to the lender, $433,000 total. So you paid $433,000 for a $225,000 house. The difference in those numbers, again, is $209,000 of interest. That's a huge number. You have, at 6% on a 30-year mortgage, you have paid almost, and again, it's with a huge down payment. If we do something crazy here and don't have any down payment, you have paid more interest than the principal, than the value of the house. If you do zero down payment, If you do $45,000 down payment, a 20% down payment, then you have paid almost as much in interest as you paid for the house. So again, if anybody does do a mortgage, I always encourage them to do as short a one as possible. These two columns illustrate that very clearly. Even before we get into anything about 50-year mortgages, remember what we've seen here. Shorter mortgages save you money. All right, let me hide this column for just a second. We'll come back to it. So let's say we do our same $225,000 house, our same down payment. So we borrow $180,000 over 50 years instead of 15 or 30. So there's no readily available 50-year mortgage rates. So as you see in my very bottom note, I depended on some people on the internet to speculate, but this is about right. So you go back to, this is about what I would expect. If a 30-year is 6%, then about 0.75% above that is about what I would expect on a 50-year mortgage. Go back to what I said earlier. You're introducing more risk to the lender by spreading this out over 50 years instead of a shorter time period, and so you're going to pay a premium in interest rate to that lender. And so now here's where the math starts to work against you. The payment on a 50-year mortgage is not really that much lower than the payment on a 30-year mortgage. It's some lower, and so if you're shooting for the lower monthly payment, which we'll talk about in a minute, then congratulations, a 50-year mortgage will do that. Well, let me just walk you through the math. I don't have a column for this. If you did a 100-year mortgage, that payment's going to be, monthly payment's going to be lower too. But where it really beats up the lender, or I'm sorry, the borrower, that's you, and where I'm sure the banks are just clamoring to have the government start supporting 50-year mortgages is this. Look at this. For a $225,000 house, you're paying $674,000 over that 50 years. Obviously, you're paying almost twice what the house cost in interest. In fact, it's less than $1,000 difference. You're paying almost $450,000 in interest for a $225,000 house. That's 2 times as much interest as you paid for the house itself. And again, if you had a lower down payment, then that's going to get worse. If you had a higher one, it would get better. But still, the fact is that spreading this out over 50 years, spreading out payments over 50 years is not a good idea. You are making a bank very happy. You're making somebody, an investor or a bunch of investors in a bank rich. And guess what the opposite of rich is? Well, not rich, we'll just say it that way. That's what you're making yourself by signing up for a long mortgage like a 50-year mortgage. So this other column that I hid, as I said earlier, one of my previous videos I talked about some of the financial and the mental, the mental more than anything, aspects of of debt. And so a lot of folks ask, as I say here in my column, they don't ask what's this going to cost me. They don't ask what's the total interest, what's the total that this house is going to cost me. They simply ask what's the payment. And so if you can afford a $225,000 house with a 20% down payment, let's say you've got $45,000 in the bank, and you look at your monthly budget and you can say I can afford somewhere around that $1,450, $1,460, $1,460 a month. I can afford somewhere around that payment. A lot of lenders that you talk to will ask you that. That will be the question that they'll ask you. They will say, well, what kind of monthly payment can you afford? And if you say, $1,450, $1,460, somewhere in there, they're going to say, well, you could buy, and then they'll ask, what kind of down payment do you have? And you can say, well, I've got about $45,000 I can put down. They might tell you, well, you can buy a $225,000 house with that down payment and end up somewhere in that $1,450, $1,460 range on a monthly payment. But they're looking at this number. They're not telling you this number. They also might say, well, if you've got $45,000 to put down, and assuming this 50-year mortgage thing goes through, You've got $45,000 to put down. We can get you that same monthly payment, but you can have a $295,000 house. And I promise you, when you start looking at houses, for you younger folks, I've been through this. I ended up building a house. If you start looking at building a house, it's going to be the builder on the other side of the table. If you start looking at buying houses, it's going to be a realtor on the other side of the table. They are going to want you to build or buy more house, simply because they make more money if you build or buy a more expensive house versus if you build or buy a less expensive house. That's going to be a pressure you're going to face. It's the worst form of peer pressure you'll ever face, because they're not just offering you, a more expensive house is going to be, in general, bigger. It's going to be in a better location, closer to work, closer to town, whatever. It's going to have more land with it. It's going to have a pool versus not having a pool. It's going to have a bigger garage. It's going to have a shop out in the backyard. There's going to be tangible things. In general, a more expensive house is a more desirable house for a lot of reasons. But is it what you need? And is it in the best interest of you and your family's financial security going out some number of years in the future? So let's say somebody talks you into building or buying a $295,000 house instead of a $225,000 house. And they simply focus on this, well, you can afford it, because if you can afford this $1,458 15-year mortgage, well, surely you can afford this $1,456 50-year mortgage. And you think, well, yeah, it's the same monthly payment essentially. Of course I can afford that. They don't want you to know these numbers down here. Look what happens. You buy a $295,000 house on a 50-year mortgage instead of a $225,000 house on a 15-year mortgage. Put down the same $45,000, same monthly payment within a dollar or two, but instead of paying $307,000 for your $225,000 house, you're paying $918,000, almost $919,000 for a $295,000 house. I'm telling you, people who will succeed in their financial life, they don't look at this number. I mean, they do. Obviously you've got to be able to make the monthly payment along with your other bills. Look at it, look at it. But if you can't do this calculation down here, these numbers, especially this line that I've got highlighted, the one below it being interest, which is a byproduct of this calculation. If you can't do this calculation yourself, ask the lender to do it, to give you the total cost of the transaction they're asking you to sign up for. Find a financial advisor who can do it. We'll go back to this screen because we're done with the spreadsheet. Email me. I'll be happy to do this. It's a very simple spreadsheet. It's something you've got to concentrate on, because the total cost of that loan is not the monthly payment. It's everything that I showed you below that. It's at line 10. You've got to understand that. So again, I don't want to get all into the politics, tangled up in the politics. I think it's a bad idea. The government has a bad habit of doing this. As I said earlier, it's a bipartisan problem. The 50-year mortgage idea is being floated because it does, according to the government, solve a problem that exists, which are housing prices are high. But it's akin to slapping a Band-Aid on a head injury. It addresses one very small symptom, which is the monthly payment, but it completely ignores what's going on inside. It completely ignores the underlying reasons why housing prices are so high. In ignoring that, it's going to end up, if it does pass, and I hope and pray that it does not, but if it does pass, it's going to rope a lot of very good people into making a very bad decision. Don't let one of those people be you. So again, if you like this video, please like it. If you have any comments on it, I'd love to hear them. Please add some comments. If you want to see more videos, please subscribe, and I'll put these out as the opportunity arises. And hope this one helped, and I'll see you on the next one.